Welcome to this course on quantitative investment management. This is being brought to you by IIT Roorkee under the NPTEL program of the Ministry of Education, Government of India. So, I am JP Singh from the Department of Management Studies here at IIT Roorkee. Now, let us talk about the scope and proposed coverage of this course. I have divided this course into three broad segments: the fixed income securities segment, the financial derivatives segment, and the equity securities segment. Talking about the fixed income securities, I shall be talking about valuation of bonds, including embedded options covering bonds or holding bonds, interest rate risk, the concept of duration, and also the yield curve dynamics, the concept of spot rate, forward rate, swap rates, and so on. I shall be talking about interest rate risk, that is what I mentioned just now. We talk about duration of individual securities or portfolios and the role that duration has to play in the portfolio of fixed income securities. I shall also talk in detail about fixed income portfolio management. Moving over to financial derivatives, we shall start with the features of financial derivatives and then move over to the applications of financial derivatives like forwards, futures, options, and swaps. Then we shall take up the role of financial derivatives in managing portfolios. This is a very important topic from the perspective of this course. We will come back to it. Then equity securities, we will talk about the traditional mean variance optimization concept, philosophy, or procedure that was advocated by or that was pioneered by Markowitz. Then we shall move on to the capital asset pricing model of William Sharpe. We shall talk about Ross's arbitrage pricing theory, and then we shall talk about equity portfolio management, what strategies can be used for equity portfolio management. So, this is broadly the coverage that I envisage, that I intend to bring to you as part of this course on quantitative investment management. This course is extremely relevant for students who plan or who are in the process of doing the CFA program of the US, in particular the stage 2 and stage 3 of that program. MBA students will also find it immensely useful, particularly those who are specializing in finance and who have done rudimentary work in security analysis and portfolio management. In this context, I would like to say that this course plans to build upon the SAPM framework that we traditionally offer at the MBA level. Chartered accountants students, cost accountancy students, company secretaryship students will also find it useful as part of their curriculum preparation. Undergraduate and graduate courses in commerce and management, they will also find this course extremely relevant. This course is expected to attract recognition in the entire financial services industry, that includes banks, that includes stock and commodity exchanges, stockbrokers, portfolio managers, investment bankers, and market regulators as well. Now, we come to the recommended readings. The recommended readings are in fact part of the CFA reading list, and I will read them out for you. Introduction to Fixed Income Analysis by Frank Fabozzi and Stephen Mann. This is for the fixed income part of this course. Quantitative equity in investing would cover the equity portfolio. This is also by Frank J. Fabozzi and co-authors. Then, as far as the derivatives are concerned, I find the book by John Hull, a classic really by John Hull, titled as Options, Futures, and Other Derivatives. It's a wonderful textbook and it is acclaimed the world over for MBA students in particular. Then I also would recommend that learners should visit the two courses, the first one on security analysis and portfolio management, and the second one on financial derivatives and risk management, offered by me in earlier years on the NPTEL platform. These can be accessed on the links that are given on the slide, and a lot of material on these particular topics is already covered in these areas, and as I mentioned, I plan to build upon this coverage. The USP of this course, this is planned to be offered as a concept based package backed up by mathematical validation of results. Wherever required, we shall prove mathematical evidence, mathematical proof of results that have been utilized in practice and by practitioners. Then extensive PPTs will be there, as is usually the case on the NPTEL platform. Supplementary notes would be provided wherever required. Assignments and work through problems will form another USP or part of the USP of this course. The structure is conventional in line with the NPTEL framework. 30 lecture hours would be there, spread over 12 weeks and together with weekly assignments which the students have to solve and submit on their own, and then we have a final exam which will probably cover 60% of the weightage of the total course. The tentative course plan that I have in mind is today's lecture, that is the first lecture, would cover overview and introduction. In the second lecture, I plan to introduce the concepts of risk and arbitrage. Then from lectures 3 to 10, we shall move into the fixed income segment of this course or fixed income securities segment of this course. It would cover bond pricing, it would cover interest rate risk, yield curve analytics, the various types of interest rates and the interrelationships between them. Fixed income portfolio management would also be covered in this segment of this course. From 11 to 22 lectures, I plan to cover derivatives, their applications, the basics, the applications and their role in portfolio management. Lectures 23 to 30, I plan to devote to mean variance portfolio optimization, factor models, CAPM and APT and equity portfolio management. So, this is the tentative course plan that I have in mind. So, let us start with defining what exactly we mean by a security. In common parlance, we define a security or we talk about a security as a tradable financial instrument which can be traded across or on any appropriate exchange, like we have shares, listed shares, we have debentures, we have bonds and so on. We shall come back to it in a minute. For the purpose of analysis, a security constitutes a point in risk return space. Now, let me give you a background, contextual background of what exactly I mean by this sentence. You see, whenever we talk about the appraisal of financial investments, whenever we talk about putting money in a project or in a particular security, we analyze the investment on two perspectives. We look at the expected return that we are going to derive from holding that security, and then we talk about the what is the probability or what is the certainty associated with the realization of that expected return. That takes us to the context of risk. In other words, when we talk about the evaluation of an investment proposal, we do it on two parameters, two fundamental parameters. One is the expected return and the second is the risk. For the moment, I will not talk about the measures of either of the two, that will follow in due course, but expected return, how much you are likely to derive by holding that security and what is the likelihood of realizing that particular expected return. So, these are the two parameters that constitute the valuation or the evaluation of investment proposals. So, we can define investments, we can identify investments on a two dimensional framework with usually the x axis denoting the risk content and the y axis denoting the expected return content. And on that basis, we can say that a security is identified by a point in risk return space, the two dimensional space, x axis risk, y axis expected return. Now, the definition of a security is also dependent, or is rather in fact primarily dependent on the legal environment in which that particular definition is being considered. For example, let me illustrate this point by an example. Securities under the Securities Contract Regulation Act of 1956 are defined as what we have on the slide. I will quickly read it out. Securities include shares, scrips, stocks, bonds, debentures, debenture stock or other marketable securities of a like nature in or of any incorporated company or other body corporate. It includes derivatives, units or any other instrument issued by any collective investment scheme to the investors in such schemes also form securities or also come under the definition of securities. Units or any other such instrument issued to the investors under any mutual fund schemes are also securities. Government securities are naturally government securities. They are part of the definition of securities. Such other instruments as may be declared by the central government to be securities, rights or interest in securities. So, this is a, please note, this is an inclusive definition, this is not an exhaustive definition, it is not an all inclusive definition, it is a definition which illustrates what are the types of securities, but of course, there could be securities outside the classes that I have identified, which would be also designated as securities, identified as securities, because we, if you recall at the beginning of this definition, it says securities include, that means these are illustrative, it is an illustrative list of securities which is given here in these two slides. Classification of securities, the broad classification of securities that we have in the context of security analysis is, we have debt securities that include bonds, etc. We have equity securities, which all of you are likely to be familiar with, equity shares. We have hybrid securities. Preference shares form a typical example, a typical illustration of what hybrid securities are. We also have convertible securities, which are hybrid. Then we have financial derivatives. I will talk more about them in a few minutes. So, these are the four types of securities, the four broad categories of securities that are identified for the purposes of analysis. Debt securities are securities that are issued under a contract of borrowing of money by the issuer. These securities embed a promise of repayment of amount borrowed plus interest for the period of borrowing. Bonds, debentures, commercial paper, treasury bonds, promissory notes and treasury bills are all examples of debt securities. So, the basic thing is, the basic characteristic of debt securities is that there is an underlying relationship of lender and borrower which relates to the issue of these securities. There is an underlying relationship of lender and borrower, please note this point, lender and borrower, which covers or which relates to the issue of these kind of securities. The agreement under which such securities are issued, that is the lender borrower agreement, is usually referred to as the indenture. The terms of the indenture include details of the borrowing, repayment terms, interest rate and computation, other features of the security that include convertibility, indexation, etc. Again, we shall talk about these things in more detail once we get into the substratum of this segment of this course. Covenants that are to be followed by the borrower, that is also important. Very often when you borrow money from a lender, the lender imposes certain restrictions on the deployment of that money, as well as the management of operations like the appointment of nominee directors. That is a typical illustration, payment of dividend, disposal of undertaking or part thereof. All this kind of covenants are introduced in the loan agreements, and the borrower has to obtain the permission of the lender before undertaking these kind of activities. These are called covenants. Then we talk about equity securities. Equities refers to a share of ownership of the company. Please note this very fundamental difference between debt and equity securities. When we talk about debt securities, we are talking about a relationship of lender and borrower. The borrower is the issuer of the debt securities and the lender is the holder of the securities. Here, when you hold an equity share, you are a part owner of the company. For example, if you hold even one share of RIL, you are a part owner of RIL. Equity holding usually generates earnings in the form of dividends, in contrast to the debt securities which generate earnings in the form of interest. The lender receives interest from the borrower and at periodical intervals as per the terms of the contract of lending. And here, in the case of equity shares, we have the earnings are distributed, or part thereof, part of the earnings are distributed as to the shareholders, and they are called dividends. We will again come back to it in a minute. Prices of traded equities change frequently. Now, this is an interesting feature. The prices of debt securities, even if they are listed on the exchange, do not change so rapidly as the prices of equity shares, which change very rapidly, very rapidly. In fact, in particular, the equity shares that form the, for example, the BSE Sensex, S&P Sensex change extremely rapidly, change in seconds really, and change by significant magnitudes as well. So, prices of traded equity frequently changes, giving rise to capital gains and losses. And let me explain the term capital gains. The increase in price, increase in value of a particular asset gives rise to capital gains. For example, if you bought a share at 100 rupees, you dispose it off at 120 in the market by selling it in the stock market, you get a profit of 20, that is called capital gains. Now, please note the fundamental difference between capital gains and dividend. Dividend is part of the profits that are distributed by the company to all its shareholders in proportion to their holdings usually. However, as far as capital gains are concerned, they are generated by the market, by the prices of the securities fluctuating in the market. If the prices increase, you are likely, and you dispose of the share, that is called capital gains if you have earned a profit, and if the prices decrease, you make a capital loss. So, capital gains are related to market transactions, dividends are transaction inter se between the company and the shareholder, whereby the company distributes part or whole, as the case may be, of its profit to the shareholders. Thus, return from investment in traded equity comprises primarily of capital gains. So, this is empirical observation that very often the amount that you derive as returns from holding equity portfolios and equity shares is through capital gains, and only a minimal amount is derived through dividends. This is usually the case. Again, there may be situations where this principle is violated. There may be situations where the capital gains is insignificant, shares are infrequently traded, companies on bad days, companies incurring loss, and there are very few takers of those shares, in which case liquidity of the shares would be low, and even capital gains would be unlikely in that event. However, in that situation, capital gains may not be significant. However, if the company decides to declare dividends out of earlier profits, for that matter, profits that have accumulated over the years, that could be part of the dividends. Debt versus equity, philosophical issues. So, what we infer from the discussion that we have been doing for the last few minutes, equity implies ownership, equity takes substantive business risk. Now, please note, this is a consequence of equity being owners. It is ultimately the owners of the company that take the business risk, and equity representing the ownership stakes are responsible or are attributed the business risk of the company. Now, we come to an important issue that is called limited liability. I will discuss it in brief. The basic meaning of limited liability is that if you are holding equity shares in a company and you have paid up the full amount that is due on those shares, for example, if it is a 10 rupee share and you have paid up all 10 rupees to the company as the value of the share to the company against maybe against application, allotment and calls and whatever the case may be, then you cannot be asked, this is very fundamental, once you have paid up the full amount on the shares, you cannot be asked by the company under any circumstances to pay any more amount for example, for the redemption of the liabilities. Even if the company has significant liabilities and is not in a position to make payment to those liabilities out of existing funds, it cannot approach the shareholders, provided the shareholders have made full payment against their shares allotted to them. This is called limited liability. The liability of the shareholders is limited to the extent that the shareholders are liable to pay on the shares. Once whatever they are liable, they have paid, the liability is over. They cannot be asked to pay any more, for example, for the repayment of debts of the company. In debt, the credit risk is paramount. As I mentioned, in the case of equity, the paramount risk, the cardinal risk is the business risk, the risk of the business doing well, or the risk of the entire business operations, including marketing of the product, including the operations, the finance and everything. Debt on the other hand has the credit risk as the cardinal risk. Debt is more risky for the borrower and less risky for the lender compared to equity. Now, this is an important statement. As far as the borrower is concerned, the debt is more risky than equity, because debt envisages a fixed charge by virtue of interest. Again, I will come back to it. However, in the case of equity, if the company has profits, it pays dividends. If the company does not have profits, payment of dividend is not mandatory by any means. Borrowing leads to monitoring by lenders through nominee directors or co-warrants, as I have just explained. So, there could be situations where, for example, these directors who are nominee directors would be more worried about their stake, that is the stake of the lenders in the company, in contradistinction to the overall business environment of the company. In other words, what I am trying to bring to you is that there could be situations where the creditor's stake as presented by the nominee directors would supersede the optimal business decisions or decisions based on the optimality of business environment, and that gives rise to what is called agency costs. So, let me reiterate, there could be situations where the business could be asked to make suboptimal decisions and take account or take cognizance of the interests of the lenders rather than the overall business interests or the interests of the shareholders. In other words, the interests of the lenders may supersede the interest of the shareholders. There could be situations, and this would obviously result in suboptimal decisions. This related concept is called agency costs. So, let me reiterate, agency costs is a situation where the interests of the shareholders are compromised with in order to benefit the interests of the lenders. So, debt versus equity technical issues. Now, as I mentioned, the bondholders of the company or the persons to whom bonds have been allotted, person to whom debt instruments have been allotted, get interest because there is a subsisting underlying contract of lending and borrowing between the issuer of the bond, issuer of the debt instrument and the holder of the debt instrument. The holder of the debt instruments has lent a certain amount of money to the issuer of the debt instrument, and the issuer has to pay interest thereon. And of course, the repayment of principal. So, the important thing here is that this interest that the issuer of the bond instrument, issuer of the debt instrument has to pay is a mandatory payment. In other words, it must necessarily be paid irrespective of the company making profits or losses. And secondly, it is a fixed payment. It is usually a fixed payment. Of course, we do have floating rate bonds, but we will come back to these things, these intricacies, these nuances later on. But for the moment, you may consider, you may assume, or you may understand that usually interest on debt instruments is a fixed payment, is a fixed rate payment. However, dividend is discretionary, as I mentioned. Dividends are distributions of profits. So, if there is no profit, there is not likely to be any dividend. So, dividend is discretionary. In fact, even if the company has made profits, it is not essential that the company distributes the entire profits by way of dividend. It may retain a part of the profits for future investments in operations or capex or whatever, and it may, on the other hand, it may also decide not to distribute any of the profits that it has incurred. It is essentially the decision of the shareholders in general meeting as recommended by the board of directors. So, a part of this discussion relates to the interest being a fixed charge. It is a charge, it is a fixed charge in general, whereas dividend is not a charge. What exactly does it mean? It means that if the dividend need not necessarily be paid, it is the discretion of the company if there are profits, and of course, if there are no profits, there is a unlikelihood of any dividend arising therefrom. Interest is a fixed payment and it is a mandatory payment, both the things, you see. Firstly, it is a fixed payment in general, and it is also a mandatory payment. You must pay interest irrespective of whether you are making profits or losses. Dividends, no, Now, the tax treatment differs. You see, what happens is, this is you must necessarily understand this, it is very interesting, it is very intriguing. When you pay interest, you can debit the interest to the profit and loss account, to the statement of total income, taxable income, that is. What does it mean? It means that when you pay interest, you debit that interest to the profit and loss account and the taxable income. Your taxable income will naturally decline. Suppose your taxable income is 1000 rupees. Now, if you suppose the income before interest is 1000 rupees, I am sorry, and you pay 100 rupees as interest, then your income after interest goes down to 900, and you will be taxed on 900, you will not be taxed on 1000. This is the meaning of the fact that tax interest is tax deductible. Let me repeat, if you debit if you pay interest on a certain borrowing, that interest can be debited to the profit and loss account, that interest must be debited in fact to the profit and loss account, and as a result of which, when you pay interest, your taxable income declines, and because your taxable income declines, the tax that you pay thereon, it also declines. This phenomenon is given a name. It is so important that it is given a name. It is called the concept of interest tax shield. Interest tax shield. Whenever you pay interest, you debit interest to profit and loss account or your taxable income, or your, for that matter, your taxable income declines, and the tax that you pay also declines. As I mentioned, if your income before interest is 1000 rupees and you have paid 100 rupees as interest, then your taxable income is 900 rupees. So, you will pay tax only on 900 rupees, you will not pay tax on 1000 rupees. So, that is the fundamental concept of interest tax shield. Now, contrast this with the dividend situation. In the case of dividend, you do not debit it to the profit and loss account, and nor is it allowed, nor is it explicitly allowed as a deduction when you calculate the taxable income of the company. I repeat, dividend is not debited to the profit and loss account, nor is it explicitly allowed under the Income Tax Act when you work out the taxable income of the company. The result is that, carrying on with the same example, if you have paid, if you have a income of 1000 rupees and you paid 100 rupees as dividend, you will have to pay tax on 1000 rupees and not on 900 rupees. So, this is the fundamental difference between the two. Dividend does not enjoy tax shield. The reason therefore, the reason for this contrasting procedures under the Income Tax Act, contrasting application under the Income Tax Act, is that interest is a charge against the profits, and therefore, it is treated at par with other expenses of the company. The company does not have any discretion insofar as the payment of interest is concerned. The result is that the income tax authorities recognize interest as a part of the expenses of the company, mandatory expenses of the company, and therefore, they allow this to be debited to the profit and loss account. In the case of dividend, it is treated as an appropriation of profits, it is treated as a distribution of profits, and because it is treated as a distribution of profits, not a charge against the profit, it is not a mandatory payment. Therefore, the income tax authorities do not recognize it as an expense debitable to the income tax statement and the calculation of taxable income. Because debt is less risky for the lender is able to part with the money, to give up this money at a lower rate. Then interest tax shield further reduces the cost of debt. We have explained that particular process. Then leverage by way of replacing equity by debt simply magnifies the earning irrespective of whether they are positive or negative. If you replace equity by debt, that is, you are incurring leverage, you are taking advantage of leverage, you are replacing equity by debt, you are replacing a discretionary cost by a mandatory interest payment, and therefore, but that rate of interest payment is usually lower in the case of debt, as I mentioned, because it is less risky for the lender. The lender can part with this money at a lower rate, and therefore, what happens is that the overall earnings, the net earnings of the company get magnified when you take when you use leverage. But the important point here is that the magnification is both ways. If your profit is higher, the profit will become even more higher if you take advantage of leverage. But in Similarly, in tandem with this particular point, if the losses are there, then the losses will get magnified, because if you take advantage of leverage, or if you replace equity by debt. Why? Because equity is not a mandatory payment, so it would not form part of the losses. However, interest is a mandatory payment irrespective of whether you are incurring profits or losses, and therefore, your losses will get magnified. Thus, excessive leverage results in escalating the risk profile of the borrowing entity, because if you are incurring losses, the losses will be magnified by if you undertake leverage. So, we shall continue from here after the break. Thank you.